Sir, can I start now? Professor, can I start now? My dear faculty members, I am here before you to introduce and welcome one of the great chartered accountants by name Chinnaswamy Ganeshan, who happens to be a member of IFRS committee, and he happens to be the guest faculty for all 5 regional councils of ICAI in India. I am so happy to introduce this great personality to you. Chartered accountant Chinnaswamy started his career as chartered accountant in 1988. Initially, he has worked with Lovelock and Lewis as a director. From 2005 onwards, he was associated with many big business houses and multinational organizations as an auditor and advisor on international financial reporting, taxation, and due diligence and other assurance services. Presently, he is the senior partner and head of audit and assurances of Messrs. CNGSN and Associates LLP Chartered Accountants firm with 10 partners and 120 members. He is specialized in the area of financial reporting, including IFRS, IND and US GAAP. He is the recipient of many awards like Jewel of India Award, Certificate of Excellence for his contribution in the field of financial services. He has presented 950 and odd scholarly papers in various workshops, conferences and seminars, both national as well as international level. He assisted 78 and odd companies on IND transition. He is closely associated with Institute of Chartered Accountants of India, New Delhi. He is a guest faculty for all 5 regional councils. He was co-opted member of Accounting Standards Board of ICAI. He was also co-opted member of IND Implementation Committee of ICAI, which is nothing but the committee involved in implementation of IFRS in India. He has published many books on IFRS and IND AS. Now he is revising these books and bringing out the student edition also. He is the member of academic councils and syndicate body of many universities in South India. So with these words, a brief introduction I have given to my faculty, and I am asking my faculty to listen to his voice very carefully and very sincerely. Definitely another 1.5 hours time, he will going to give you an insight about how in IFRS, how this IFRS has been introduced and how IFRS has been converged into IND AS. So these are the very important aspects that he will going to cover. So with these words, I welcome Chinnaswamy Ganeshan to address the gathering. So you please address the gathering, sir.
Thank you so much, sir. First of all, my sincere thanks to you, sir, Dr. Sivalinga Gowda, Principal of Sri Puttaswamy First Grade College, Mysore, as well as your entire team for creating such an initiative of introducing IFRS to the faculties. I feel that this is very important for 2 main reasons. One is the commerce curriculum is completely changing. For example, when I'm talking about chartered accountants who are pursuing their articleship, students of chartered accountancy, has to necessarily study only the IFRS converged Indian accounting standards, or what we call as IND AS, which will be discussed over the next 2 days in depth for the benefit of the faculties. So the entire syllabus of financial reporting is full only with IFRS converged Indian accounting standards. That's the one main change which has happened on the CA curriculum. And many of the commerce graduates who wanted to do CA, because the direct entry is permitted from BCom to the articleship. So we have to mold their career with so much of knowledge on this particular subject. That is first point. The second point is also, suppose if somebody is only completing the commerce program and wanted to go for an employment, maybe in the finance team or in any other team which is preparing the financial statements for the purposes of presenting to the stakeholders, the first requirement is small companies, small job is okay. But if you are looking for multinational companies, if you are looking for bigger companies, all those companies like listed companies, all those companies has to necessarily prepare and present their financial statement only under IFRS converged Indian accounting standards or IND AS. And accordingly, the people who are completing their BCom with us should also be having a complete understanding of IFRS converged Indian accounting standards for their employability. On these two counts, this type of seminar, I believe that it's a completely and real innovative program which the college has actually planned. And accordingly, I believe that this is what is important when we are talking about preparing our students for the future. And I will start sharing my screen where I will be presenting a small presentation for all of you. Hope you are able to see the screen, sir, with the PPT. So somebody can confirm whether they are able to see the screen.
Yes, sir. There is, sir. Yes, sir.
Yes, sir. Really,
Yeah.
we will.
Okay,
Yes, sir.
Okay, thank you, sir. So what we are actually planning in this session is to give you a complete overview of the IFRS converged Indian accounting standards, that is IND AS, and how the financial statements are presented by companies using IND AS. Of course, there is a separate standard called IND AS 1, which talks about presentation of financial statements. But I'm not going to touch that particular standard because there is a separate session where another faculty will be discussing that at length. But what I will be doing is that I will consider the presentation of financial statement in accordance with the requirements of Companies Act 2013 and in line with IFRS Converged Indian Accounting Standard. There is a schedule called Schedule 3, which has been introduced by the Companies Act 2013, specifying the format in which the financial statement has to be presented by Indian companies who are using IFRS Converged Indian Accounting Standard. So, as far as we are concerned, we are going to talk about IFRS Converged Indian Accounting Standards, which is IND AS. As far as India is concerned, if you call IND AS, that is called IFRS because we are only having some 3-4 small differences between IFRS and IND AS. And once a company prepares as per IND AS and they are making adjustment for those 4-5 changes which we call as carve in and carve out, that is mainly to suit Indian economical conditions and Indian regulatory perspective. When we are making that changes and making the adjustment entry, like what we prepare for a bank reconciliation statement, starting from the balance as per passbook and going to balance as per the bank book. So when we are working out the similar way, the financial statement as per IGAP and the financial statement as per IND AS is the first transition which we will do. That is what is required to be done by all the companies in India who are following the IFRS in India. The second level of convergence is between IND AS, you make a reconciliation with IFRS in case the company is also tapping the market overseas and the overseas stock markets are expecting the company to present the financial statements under IFRS. In simple terms, before I go into the slides, one thing which I wanted to tell you is that the financial statements prepared under IND AS is more or less equal to IFRS financial statement. And to that extent, India has marched towards the pole position on convergence with IFRS. Few differences. and the few differences has been accepted by the International Accounting Standard Board. This is the first point which I wanted to tell you to get prepared for it. So let us understand what is IFRS and why we have to converge with IFRS. This is the first question which will come to everybody's mind when we are having a seminar on IFRS within bracket Ind AS. So first thing is, this is potentially a survey which has been conducted a long back when International Accounting Standard Board has made it mandatory to apply IFRS by European Union. And after the European Union and the companies in European Union started using this, the assessment was whether the IFRS is really important for the economic growth of an entity or not. This is the various survey questions have been asked. One of the important survey questions which has been asked is basically to assess whether this IFRS change, convergence from normal accounting standards to IFRS and presenting the financial statement as per IFRS is going to be important for the economic growth. This survey, along with other questions, has been asked between 143 leaders from different countries, around 91 countries at that point of time, because 91 countries have adopted somewhere in 2017. And now, if you consider, the count is more than 150 plus. So this 143 leaders is not only the leaders of the country, but also the finance professionals, the various policymakers, the academicians. With all those people, economists, it has been asked this question. And the outcome is very interesting. The outcome said that 55% of the people have felt that it is very important for the economic growth of an entity. 35% have said it is important for the economic growth of an entity. 9% have said somewhat it is important for the economic growth of of a country. Now, if you consider this cumulative result, almost 99% out of 100% of the total population have said implementation of IFRS is really going to help the economic growth. How? The reason is very simple. When I talk to you, if I talk in Tamil, you will not be able to understand fully. Similarly, when you talk in Kannada, I'm not able to understand it in full. But the critical information which we wanted to pass on should be very clearly communicated, otherwise there will be a gap and misunderstanding. So what we normally try to use, we try to use a common language which can be used by the communicator and by the person who is receiving the communications. Like I am speaking in English and you are also hearing that in English. So we look for a common language so that the communication is totally seamless and totally relevant and totally impactful for anybody. Similarly, when somebody is preparing a financial statement, say for example in India, I prepare as per Indian GAAP. GAAP is generally accepted accounting practices. I use Indian GAAP to prepare the financial statement and I am presenting to an investor in a foreign market. How the foreigner will be able to understand Indian GAAP? So there is a requirement for a common accounting language. That common accounting language is what we are considering as IFRS. So if I prepare in the language known to the user of the financial statement, the user will be more comfortable having the complete trust and understanding of the way in which the assets, liabilities are presented, income and expenditure are presented, what is the key performance indicators of the company. So that creates a great level of comfort feeling for the investor to invest in this company. So inward and outward, inbound and outbound investments is very easier when somebody is using a common accounting language. That's the idea behind implementation of IFRS throughout the world, and more than 150 plus countries have already started using it. India has also started using IFRS converged Indian accounting standard. So that is the main reason. But only one thing which I wanted to talk about when we are talking about the new rules of financial reporting, I always believe that we should not jump to any conclusion. Just to make a small icebreaker, let us watch this small video and Let us debrief after that. So, majority of the time, what we believe is that we are trying to help somebody else without knowing what is exactly is happening. And this type of disasters or chaos can be possible. The same thing is applicable when we are talking about teaching the IFRS Converged Indian Accounting Standard. The utopia which has been created, or maybe the illusion which has been created, which I can talk to each one of you, is that IFRS is difficult. Because of that, IFRS Converged Indian Accounting Standards is also difficult. It's impossible for you to understand as a faculty. And because it is impossible for you to understand, it is impossible for you to teach to your students about IFRS. But I always believe that it may be difficult, but it is still possible. And if we are not able to do it, who else can do it? That is what I used to say. So don't jump to the conclusion that it is impossible for me to understand and train my students. That's the first request which I'm putting on this. So just to have a background of the IFRS, let me just tell you that there are confusions with among the users of IFRS. There is confusion among even the educational institutions. There are confusion among the professionals. What exactly is IFRS is? For example, one of my friend who is a practicing chartered accountant has told me everybody is objecting implementation of IFRS in India because IFRS should have been implemented in 2010 as per the original roadmap, but it has been pushed to 2015-16 for the first time. So nearly 6 years it has been postponed. So he was very critical of that particular postponement, saying everybody is worrying about IFRS being implemented in India. Why people are having that bad thinking? I believe that it's better to implement IFRS because Indian GAAP actually has nearly 32 standards to be read, understood, and the training should be imparted on 32 standards, right from the first standard on significant accounting policies and the last standard on financial instruments, presentation and disclosure. Instead of 32 standards, if I'm talking about IFRS, I should only look into only 12 standards at the, not even 12 standards, at the time it's only 8 standards when he was making that critical comment. IFRS 1 to IFRS 8. IFRS 1 on first time adoption of Indian accounting standards and IFRS 8 on operating segments. So he said, instead of reading 32 standards, we are going to read only 8 standards. Is it not simple? And the syllabus is actually made very, very easy without elaborate content. So 32 versus 8, almost 75% has been now given as a concession in the level of or the quantum of the total impact. That's what his point of view. And unfortunately, I have to explain to my friend, sorry friend, it is not like that. The concern is really, really challenging for a simple reason. The accounting standards issued by the International Accounting Standards Committee, IASC, who was the standard setting body till 2001. In 2001, there is an enhanced body which came in. We will see that little later. The International Accounting Standards Committee has started issuing standards called International Accounting Standards. At that point of time, there is nothing called IFRS. It is called only International Accounting Standards, or IAS. These standards have been issued with a prefix called IAS, IAS 1, IAS 2. Like that, they have issued nearly 41 standards. Whenever a standard has been issued, people are finding it difficult to understand certain concepts, so they are asking for clarification. When they have asked for the clarification, what has happened was they have to be provided with some sort of interpretations which has to be applied. So those interpretations have been given by means of a committee, subcommittee, which has been formed called Standards Interpretation Committee, Standard Interpretation Committee, which is called SIG Interpretations. Don't think that it is called what you call uh, really sick to understand international accounting standard. So it's only Standards Interpretation Committee. That's the thing. So at that point of time, Ind AS 1 to Ind AS 41, and of course certain standards in between have been merged with the existing standards. So effectively there was some around 32 standards at that time. So that 32 standards is equally converted into Indian GAAP as well. So 32 standards were there at that point of time, and those were literally speaking a part of international financial reporting standards, or IFRS, at that time. But once the countries have started adopting IFRS in a bigger way, the operations of IASC has been considered to be requiring an enhancement in the operation. It should be broad-based in respect of its team. It should be broad-based in making research and in making understanding of the various aspects of the requirements of various countries when they are adopting IFRS. In that particular situation, what has happened was in 2001, it has been decided that the IASC will be merged with International Accounting Standard Board, a broad-based committee and broad-based board, which will prepare and present standards from 2001 and for the future. So what has happened? They started issuing series IFRS series standards with IFRS series. So when they have issued, they have started issuing IFRS 1, IFRS 2, like that they have issued 8 standards. When my friend was making that comment, only 8 standard I have to read. But the question which was before the IASB was that you are already having 32 accounting standards, which is having IAS series prefix. What to do with that 32 standards? Whether it should be completely scrapped and a new IFRS series has to be prepared. So it was unanimously agreed and understood that it will be difficult to scrap the entire standards because people are using it in the preparation of financial statements from time immemorial. So asking them to completely change to a new set is not required. Moreover, the existing standards are still relevant in certain aspects, and accordingly, the decision has been taken that wherever the existing standard provides complete guidance and relevant to the present accounting principles like recognition of an asset, recognition of a liability, recognition of an income, recognition of an expenditure, if guidance is fully available as per the existing IAS series standards, we will retain them. If the principles are not relevant and they require a minimal modification, uh, in that case, they call that as a limited revision. Even in the limited revision, what they have agreed is that still the IAS series standards will be maintained. The relevant paragraphs will be removed and modified with the new requirement. So limited revision will be done and the existing IAS series standards will be still retained. Only where the concept is totally changed, where the concepts of recognition and measurement principles are not in accordance with the current trend, they will scrap the existing standard and introduce what we call as IFRS series standards. So IAS series standards will be maintained as it is, plus new standards will be issued with IFRS series. So now, if I tell you that we are talking about IFRS, it is IAS series standards which are still relevant, SIG interpretations, standard interpretation committees interpretations, still relevant, plus new IFRS series standard. As of now, IFRS series standards are from 1 to 17. Latest one is leases has been issued. Sorry, latest one is on insurance has been issued. 17 is insurance, 16 is on leases. And Similarly, whenever IFRS series standards requires an interpretation to be done, IFRIC interpretation committee has been formed and they were issuing this. So all these put together is what we call as International Financial Reporting Standard. To give you a little bit of comparative assessment, majority of us might have seen Ramaya's Guide to Companies Act. Now it comes with 4 volumes. So the real literature of IFRS, along with the interpretations, etc., put together will be 3 times of the company's Guide to Companies Act by Ramaya. So that is the reason why people are little worried about the implementation of IFRS. But having said that, once you started believing that IFRS is possible way of communicating the strength of the company by means of its financial statement to a stakeholder, and it can be globally understood, IFRS is the best alternative compared to what each country is adopting as their accounting principle. That makes it important for the companies to go for international financial reporting standard. So to summarize whatever we have discussed, today, as of today, out of 41 IAS series standards, 26 IAS series standards are still relevant, starting with 1, going to 41. In between, certain standards have been scrapped, merged with new standard, or they have completely scrapped and new standard has been introduced under IFRS series standard. Out of 33 interpretation issued by SIG interpretation committee, 8 interpretations are still relevant and have authoritative status. Out of 17 IFRS series standards which has been issued, all the 17 standards are still relevant. And out of 21 interpretations issued by IFRIC committee, 19 interpretations are still relevant. This is the volume of literature which we are talking about as IFRS. This series of standard, 26 IAS series standard, 8 interpretations, 17 IFRS series standard, 19 IFRIC interpretation, all these have been converted into Indian accounting standards or IFRS converged Indian accounting standards. To put it in simple terms, IND AS. Okay, so these interpretations have been merged in the standard itself, because when we are issuing the standard for the first time, the explanations are automatically can be included in the standard itself instead of giving that as part of a separate interpretation. That is exactly what has been done by the Indian Accounting Standard Board operating under Institute of Chartered Accountants of India. So what is IFRS Converged Indian Accounting Standard? As I have said, there were 2 situations which were before Indian government, whether to adopt the IFRS standard as such. That means all the IFRS standards will be straight away taken as the standards for preparation of financial statement, or to converge the existing Indian accounting standards into IFRS compatible accounting standards. So this was the question which was before the Indian government and the Ministry of Corporate Affairs, and they have asked the Institute of Chartered Accountants of India for the better approach. The Institute of Chartered Accountants of India, based on the research done, has concluded that we need not adopt, we will converge, because 32 standards have been used by Indian corporates, Indian professionals, Indian students. So wherever there is a difference between Indian accounting standards and IFRS, we will eliminate the difference by converging that into an IFRS compatible accounting standard. That is exactly what they have felt. So by means of convergence rather than adoption. But what has happened in China is something interesting. We were struggling for 2010 to 2016 to make it acceptable by Indian companies, by regulators, by income tax department. Whereas in China, they have said from day one, we will have IFRS to be the standards to be used for preparation and presentation of financial statement. Can you guess why? So the normal thinking which we will be having in our mind is that because China is ruled, is a communist country, and accordingly they can pass a simple rule which can help companies to adopt straight away from day one. But the actual fact is China was not having any accounting standards before. So when I do not have anything, I can straight away copy and paste and start using it from day one. Whereas I have started using it, and we set the principles for preparation of financial statement by means of our own Indian accounting standard. So convergence was the best route which has been considered. And as I have mentioned that listing of overseas stock exchanges has become more easier because everybody is able to understand the way in which the financial statements have been prepared and presented. Investor confidence in Indian companies have improved a lot because the financial statement can be more understandable. Mergers, acquisition of Indian companies or foreign companies being acquired by Indian companies have increased because of comparability of the financial statement and the trust which can be put on the numbers which has been presented in the financial statement. So a strategic improvement in the finance systems and processes has also increased. So this convergence is what we are calling the IFRS. When it is converged with Indian accounting standards, we call that as IND AS. Indian accounting standard in short form, we are calling that as IND AS. Let us get into the new rules of the financial reporting, how the standards are being actually set. The Institute of Chartered Accountants of India is setting the standards, and these standards are called accounting standards. Those accounting standards now applicable only for non-corporate entities. That means other than companies, partnerships, cooperative banks, banking companies, insurance companies, proprietary concerns. Wherever a non-corporate entity is preparing the financial statements, they will be applying the standards which has been issued by the Institute of Chartered Accountants of India. The second set is what is important for us. Companies which are meeting certain threshold limits, maybe we will come to the threshold limit a little later, maybe because of listing, maybe because of the net worth, they have met the threshold limit. Those companies have been made to comply with IFRS converged Indian accounting standards, or what we call as IND AS. So it is like what I have started with saying, 95% compatible with IFRS. Only 5% is for our specific reasons we have made some changes. For example, IFRS is saying that when a company is acquiring another company, and the company, say for example, the total value of the net assets taken over, total assets minus liability in an amalgamation, absorption or reconstruction, whatever you call, when they are acquiring a company, that amalgamation, absorption, reconstruction is called a business combination under IFRS. There is a separate standard called IFRS 3, which talks about IFRS on business combination. So when the net assets taken over, let me just put a number, is 120 crore. Net of liability, that's what net assets taken over. Assets minus liability assumed is 120 crore. Let us take that. But the company pays only 100 crore towards that. So the 20 crore, which is paid lower than the asset, when I have to put that into the balance sheet, what happens? Asset will be recognized as 120 crore. And my bank balance will go off by 100 crore, assuming that everything is done by cash. If I'm issuing by shares also, 50% share and 50% by cash. So share capital will get increased by 50 crore and my bank balance will come down by 50 crore. So balance sheet will have a balancing activity, but the problem is 120 crore of asset has been added, 50 crore of asset has been reduced. So asset side increases 70 crore, but on the liability side, capital has increased only by 50 crore. There is a gap of 20 crore. That 20 crore, unless I put some nomenclature for that, my balance sheet will not tally. So we call that as a capital reserve, right? And put that as part of the reserves and surplus. Then balance sheet tallies. But IFRS 3 says when an asset worth of 120 crore is being purchased at 100 crore, you have also negotiated or you have done a bargain purchase. Because of that, you got a discount. So that discount or gain on a bargain purchase should be treated as a gain in the profit and loss account. So 20 crore should go to my P&L account as an income. Will you be able to accept? Difficult, because suppose if the total assets which I am taking over is 100 crore, but I pay 120 crore, what I will do? The 20 crore I will consider as goodwill and treat it as an asset. That is what IFRS 3 is also saying. On one side, if I pay higher consideration, you have to treat that as an asset and not as an expenditure. But whereas if I have done a bargain purchase, you are saying that that should be taken as an income, which we felt that it is not correct. So we continue to have that as part of capital reserve. So that is one of the carve out which we have done. Carve out means we have removed that particular the particular process and made some amendment. So that is what we call that as a convergence to suit the economic conditions in India and the statutory provisions of Indian Companies Act 2013. So certain companies has to meet based on the threshold limit. All other companies other than non-corporate companies and other than companies which other than non-corporates and those who are not following IFRS. That's the reason why I'm putting that as an other companies. There is an accounting standard rule called Companies Accounting Standard Rules 2006, which has been amended from time to time under the Companies Act 2013. They have to follow that. In simple terms, today, as a professional, I should know standards issued by the ICAI, IFRS Converged Indian Accounting Standard, and Companies Accounting Standard Rules, all put together I should know, because for the particular client, I should apply only that particular financial reporting framework. For a simple reason, when a financial statement has been prepared and presented, the first question is whether it has been prepared in accordance with the applicable financial reporting framework. So for a non-corporate entity, the applicable financial reporting framework is standards issued by ICAI. For other companies, it is Companies Accounting Standard Rules. So they cannot apply IFRS standards. They cannot apply the standards applicable to non-corporate entities. So this is a new set of rules for financial reporting. When a student has to understand, he has to understand all the three. As a finance professional also, I should understand all the three. But having said that, 3 times of volumes of Ramaya's Guide to Companies Act, don't think that understanding the financial statements prepared under IFRS or Ind AS is going to take our life like this. It is need not necessarily take life out of you, but I believe that what is required is called a detailed systematic study and a planned study. So if you see this picture, if I ask you what you are seeing in this picture, normally you will say that there is a natural beauty like a river or lake. The other side, there are some, seems to be an island. And this time, this side, some two people are enjoying the beauty. And there is a tree which gives a shade for them. That is what you normally try to say. But if you systematically and very detailedly observe this, you will find that this has a baby in this picture. For example, this is the head, and this is the eyebrows, and this is the eyelids, this is the nose, and this is the lips, and this is the hand and fingers of the hand, and this is the leg, and this is the fingers of the leg, and this forms the bottom back. So what is obvious is the branches of the tree, and we should look beyond the obvious, and that will give you the picture of the baby which is in the mother's womb. So the understanding of the new financial reporting IFRS Converged Indian Accounting Standard also requires a little bit of detailed study which you are supposed to do. Just to put you the magnitude of impact in respect of companies following IFRS, the major issue which they are having is what is the impact of understanding or implementing IFRS in my company. It is their worry. And for example, if I have reported some profits as per the existing Indian GAAP, and the profit as per IFRS comes down dramatically. Similarly, what is the net worth I have stated as per Indian GAAP, but it comes down dramatically when I am adopting IFRS. This gives a problem for the users to have confidence on the company. They will get confused. So to maintain the user's mindset, the biggest requirement is to ensure that before and after the implementation, there is no big impact arising out of it. For example, one of the company which has adopted IFRS for the first time, because of the difference in accounting policy between Indian GAAP and IFRS, had a reduction in the reserves to the extent of 39,570 crore. Please see that number again. It is not thousands or lakhs. It is 39,570 crore, which was available on 31/3/2015. On 1st of April 2015, when they have adopted IFRS, their reserves has come down to that extent because what was considered as an asset under Indian GAAP is to be treated as an expenditure under IFRS. So 39,570 crores has vanished just like that by means of one accounting principle. Another impact, we have a standard called the deferred tax accounting, and it is covered as part of your separate session. So I'm not going into that. The taxation impact, which has to be recognized in the P&L, has also come to additional reduction of 13,665 crore. So put together, the company's reserves has vanished by 53,235 crore on the reserve side. How the users will understand this when everybody relates to the net worth as a key performance indicator, whether for my credit rating, whether for my share valuation, whether for my compensation to the key management personnel, even for maintaining my earnings per share or my value per share in the stock exchanges. I'm always looking for what happened to this company when it has lost 53,000 crore in one single stroke. So the company should think about how the balancing act can be done. One side there is a reduction. Is there any possibility of you get an increase in the assets so that the impact is nullified or impact is brought to the barest minimum possible? This understanding the transition is going to be challenging. IFRS has given a transitional provision or transitional standard, which has been adopted by Ind AS also. That standard allows you to make certain deemed accounting principles. For example, when I have adjusted this number, on the other side, what they have said that when you have a property, plant and equipment, for example, land, I have a land was historically accounted at cost basis. You can think about doing a fair valuation. Fair valuation is a new concept which is coming in. You can do a fair valuation of the land and take that as the deemed cost. When I fair value the land, say for example, 1 crore worth of land is now fair valued, say for example, 50,000 crore. So the balance 49,000 crore, 49,999 crore will automatically go and increase my reserves. One side I have reduced by 50,000 crore, another 53,000 crore. Other side I am increasing the reserves by 50,000 crore. So this is one of the options. Similarly, the investments which has been made by the company, historically we maintain at cost. Those investments should also be fair valued and take the fair value to the reserves. So that's the way in which this 53,235 crore of deficit in the reserve side, the company has offset by means of increase in reserves on valuation of land, valuation of investment. That balancing act is also available under IFRS. So anybody who is applying IFRS or Ind AS should do a balancing act for the first time when they are adopting that. Holistically looking into the strategy for conversion. That is exactly is very important for that. Some people used to say, you are saying that the total literature which I have to study is 3 times of Ramaya's Guide to Companies Act. Is it possible for me not to comply with the Ind AS, like how the students go for the examination? If you are saying that these 2 chapters are very rarely being asked, so one chapter you can actually give it on choice. So you need not prepare for it. The other chapter you can actually prepare for your examination. So when the professor is giving that type of practical tips for the student to prepare for it, sometimes students try to skip even 4 or 5 chapters in total. And still, because I require only 40 marks, right, for a pass. So if you are looking at that level, if some professional or the company is also saying, no problem, I will not comply with the applicable financial reporting framework of Ind AS, but I'm ready to pay the penalty. Just see what is the impact. Companies Act under section 129 subsection 3 makes it mandatory for compliance with the IND AS or IFRS converged Indian accounting standard. If it is not complied, the managing director, whole-time director finance, chief financial officer, or any other person who has been assigned the job of financial reporting, and in case if you are not designated anybody as managing director or whole-time director, all the directors of the company will be considered as officers in default, and they have to pay a penalty of 50,000 per officer, which may get extended to 5 lakhs, or imprisonment, or sometimes both. So sometimes it comes with a bonus, right? So assuming that the company is having 7 directors, 7 into 5 is 35 lakhs is the possible penalty, subject to the possibility of imprisonment also. So no more it is attractive to be a non-compliant. So you have to comply with the provisions of the Act. Now, having said that, how I will be able to quickly understand IFRS converged Indian accounting standards and able to teach my students, I have a simple process, which is the way in which I become one of the faculty for IFRS and Ind AS over a period of time, because I was teaching mainly on Indian accounting standards, that's the Indian GAAP previously, before Ind AS has been made mandatory in India. So what I have done is a simple process. I thought that the foundation should be little strong, a good knowledge of Indian GAAP, Indian accounting standards, AS should be essential, which we know in and out because we are teaching commerce, teaching accounting to our students for number of years, and we know pretty well what is AS accounting standards are. With that good knowledge, what we require is only to understand what is the significant difference between accounting standards and IFRS converged Indian accounting standard. If those differences has been understood and you could pass reconciliation entries, you are with IFRS converged Indian accounting standard financial statements. So the significant differences, I will suggest you can download from Institute of Chartered Accountants of India website, and they have given this as a supplemental material for the final students. And similarly, you can Google out and find out difference between accounting standards and IND AS. You can find out a lot of good literatures, and those literatures will not be more than 150 pages, not more than 150 pages. Even if you are starting today to read one page, but as faculties and professors, I'm very having a very strong feeling, belief that when you start reading it, you will not be stopped with one page. So even if you assume that we are starting with 5 pages a day, what requires is only 2 weeks for us to understand clearly what is the difference between IGAP and Ind AS. So if you know that, the difference is what is the adjustment journal entry which has to be passed will be your IFRS adjustment entry. You can very easily become master in teaching IFRS converged Indian accounting standards if you follow this practical approach. And of course, what are all the changes which is happening on the Ind AS on a regular basis? You have to watch closely with the Ministry of Corporate Affairs, which is notifying these standards under section 133 of the Companies Act 2013. And I strongly urge you as a faculty to read this as well. Ind AS Transition Facilitation Group, ITFG is what we call. It is constituted by the Accounting Standard Board of the Institute of Chartered Accountants of India. Incidentally, I happen to be a member for more than 7 years in this particular ASB Accounting Standard Board, and part of that role is being part of the ITFG committee. This committee has given a lot of guidances when somebody is having a specific question on transition from IGAP to Ind AS. And these bulletins have been now come out with a e-book by the Institute of Chartered Accountants of India. So go to ici.org. Under ici.org, you can go to Accounting Standard Board. You can find all the standards available there, including the Ind AS Transition Facilitation Group Bulletin in e-book format. You can download and make use of it. It will answer many of your questions which you will be having before you start teaching the students on that. That is what the practical approach, very simple approach. So having said that, now the question is, what do you mean by Ind AS? To whom it is applicable? Because you said certain threshold limit has to be complied with, then only Ind AS will be applicable. I'm just putting it into a simple bracket. One is certain companies based on net worth. For example, if the net worth of the company is more than 250 crore, of course, the language used in the notification says if the company is having net worth of 250 crore or more, but I never saw a balance sheet which exactly has 250 crore. Plus or minus something will be there, decimals will be there. But the language used, naturally, that should be used by the student also for scoring the marks. Companies having net worth of 250 crore or more shall apply Ind AS on a mandatory basis. So any company, whether it's a private limited company or it's a unlisted company, unlisted public company, or a listed company, if they are having a net worth of 250 crore or more, should necessarily follow Ind AS. This is one of the criteria, net worth based criteria. Second criteria is based on listing. Suppose if it is a listed company, the way in which the notification has been made for all listed companies, irrespective of the net worth today, because when the first roadmap has been given, first page they have said all listed companies and other companies having net worth of 500 crore or more shall apply, and in the next year they have said all listed companies should follow. So that was in 2016. So we are in 2021, and accordingly all the listed companies, even if they are having a negative net worth, should follow Ind AS on a mandatory basis. So the net worth criteria will now be relevant only for unlisted companies. For a listed companies, irrespective of the net worth, you should follow on a mandatory basis the Ind AS. That is the second criteria. Third criteria is, maybe I'm an unlisted company, but I wanted to go for public in the near future. So companies will be tapping the stock market, and we call that company is going for an IPO, initial public offering. So in that case, those companies are considered, they have to go for a long way, because it cannot happen on a one single day. At least a preparation of 6 to 9 months is required before you start listing your shares. So the decision should be taken that I'm going to list my shares on so and so date, and that decision, the moment you have taken, you are considered as a proposed listed company. So if it is a proposed listed company, even though it is unlisted at that point of time, they should mandatorily follow Ind AS as the basis for preparation of financial statement. And this is what they have to follow as an IFRS converged Indian accounting standards or Ind AS. So three conditions: net worth for unlisted company 250 crore or more. All listed companies, all proposed listed companies should follow mandatory basis under section 133 of the Companies Act. Now the question comes is whether this is the enough. I normally say this is the first set of rules. So step one to decide applicability of Ind AS is what is the way in which I teach, because step one, step two is easily goes to the mind of the students. So step one is the initial criteria: net worth, listing, proposed listing. Second, step two, it says, suppose if, say, let us take an example, A Limited is a listed company. So it has to prepare as per Ind AS. A Limited has a subsidiary B Limited and has an investment in an associate company less than 50% in C Limited and has invested in a joint venture D Limited. Now, the point is, because the parent company is following Ind AS, the subsidiary, associate, and joint venture. In our example, A Limited following IFRS, which is the holding company, its subsidiary B Limited, its associate C Limited, its joint venture D Limited should also mandatorily follow Ind AS. So they should also follow Ind AS on a mandatory basis. On the reverse side, suppose in our example, B Limited is a listed company, but A Limited is an unlisted company. B Limited is a listed company, but A Limited is an unlisted company. So in this case, A Limited is a holding company of B Limited. B Limited is a listed company. The holding company of a listed company should also follow Ind AS. So accordingly, even though A Limited is an unlisted company, the second scenario, being a holding company of a listed entity, it should also mandatorily follow Ind AS. In simple terms, step one is talking about criteria to be assessed based on the individual financial statement of the companies. Step two is to assess whether you are part of a company following Ind AS. In that case also, you are part of this. Part of this is what you are supposed to do. Many frequently asked questions. I will quickly answer these questions, and I will also take questions after the end of the session. So whether any company can follow on a voluntary basis, permitted. For example, I'm an unlisted company having less than 250 crore net worth, but I wanted to adopt Ind AS, I can adopt Ind AS. Only point of caution is the moment you are voluntarily adopted Ind AS or started presenting financial statement as per Ind AS, you cannot go back to Indian GAAP at a later point of time. It's like a one-way traffic. Once adopted, you should follow Ind AS for your lifetime. Second is, when you prepare a financial statement, we say that the company is preparing its standalone financial statement. And in the example, we have talked about A Limited, B Limited, C Limited, D Limited. And A Limited having investment in subsidiary, associate, and joint venture, it should also prepare a consolidated financial statement on a mandatory basis as per Companies Act section 129 subsection 3. Because consolidated financial statement is made mandatory under the Companies Act, and the Ind AS has been notified as part of the Companies Act under section 133. So every company following Ind AS should also prepare consolidated financial statement if they have investment in a subsidiary, associate, or joint venture. So whether Ind AS is applicable only for the separate financial statement of the entity, that is A Limited in our example, or it should be applied for A Limited individual balance sheet as well as its consolidated balance sheet of A Limited, B, C, and D put together. The answer is it should be applicable for both consolidated as well as the standalone financial statement. What is the starting point of calculation of net worth? Because the notification came somewhere in 2013, it said that as of 31/3/2014, what is the net worth you have to consider? 500 crore, 250 crore, there are two phases of implementation which has been given. But the net worth does not include revaluation reserve. So any reserve which has been shown as a revaluation reserve cannot be used, cannot be considered. So assuming that a company has 600 crore of net worth, out of this 300 crore is revaluation reserve. The net worth for the purpose of determining is 600 minus 300. And you have to also see whether there is any depreciation which has been returned back to the reserves. You may ask this question, how it is possible? Schedule 2, when Companies Act 2013 has been introduced, Schedule 2 has prescribed certain principles on depreciation based on economic useful life. When that depreciation has been reworked, certain depreciation might have been excess charge depreciation, which is returned back to the reserve, not to the P&L account. So those amount which has been returned back to the reserve, assuming that it's another 50 crore. So 600 minus 300 minus 50. And company has acquired certain companies and there is an amalgamation reserve, another 70 crore which is sitting in. So that should also be excluded in calculation of the net worth. 600 minus 50, minus 300 minus 50 minus 700, 70. So 600 minus 300 is 300, minus 50 is 250, minus 70 is 180 crore. So even though the company is having 600 crore of net worth, our criteria is 250 crore and more in respect of an unlisted company. So it is less than 250 crore, so that company will not be following IND AS on a mandatory basis. Voluntarily, it can follow IND AS. So as I have said, if you are following IND AS for some reason or otherwise, you have to follow for all subsequent years. For example, voluntarily I adopted, I cannot come back. My net worth was 250 crore and above, so I have followed IND AS. Subsequently, because of losses, the net worth has come down. So I will say that it is not applicable to me. Can I revert back to my Indian GAAP? Not possible. Once IND AS is followed, you should always follow that for all subsequent years. When we are talking about listing or proposed listing, whether equity shares should also should be only the consideration. No, even if the company is issuing debt securities, that should also be considered. However, there is a recent notification which has been issued. Suppose if it is an unlisted company, but it has debt securities, which alone is listed, and those debt instruments have been issued on a private placement basis or on a preferential basis. For example, debentures have been issued. That has been issued to a particular bank, but the bank insisted on listing the debentures. So they have gone to the stock exchange, made the listing of the debentures, but the shares are not listed. But still they are unlisted companies according to the recent notification which has been issued by the Ministry of Corporate Affairs, effective from 1st April 2021. So from 1st April 2021, unlisted companies who have issued only debt instruments and listed those debt instruments will still be considered as an unlisted company. And accordingly, they need not follow the various stringent provisions which has been given by the Companies Act for a listed company, as well as they need not follow the principles required under the SEBI listing agreement. This is one welcome change which has been brought in. The next question which comes to our mind is whether listing the shares in Indian stock exchange alone is covered. No, even if an Indian company is going and investing in or listing in a foreign stock exchange. For example, it's very common that Indian companies are listing in Nasdaq stock exchange, US stock exchange. It's very common for them to go and list it in Singapore stock exchange. Even when you are issuing or listing your shares in a foreign stock exchange, you are get covered under the provisions of mandatory requirement to follow IND AS. Only exemption which they have given is that suppose if your instruments are listed in SME stock exchange. In India, SME stock exchange is another level of stock exchange where small companies will be able to list their shares to raise funds. Those SME stock exchange companies are outside the purview of mandatory requirement to follow IND AS. But only thing is, if it is exempted based on listing, but I have to test the net worth criteria, because either one criteria will make the company to mandatorily adopt IND AS. Suppose net worth was not 250 crore or more in 2014, but in 2019 I have crossed 250 crore. What I have to do? Because I never had that 250 crore net worth in 2014, whether the company is never follow IND AS, the notification makes it very clear. If the net worth crosses the threshold limit in a particular year, the company has to follow IND AS on a mandatory basis from the immediate next year. So in our example, we said 2019, the net worth has been, the threshold limit has been crossed. So from 2020 onwards, the company should follow IND AS on a mandatory basis. Similarly, a company was listed in 2014, but it was acquired by another company. Control has been acquired by another company, but another company doesn't want to have the listing. So they have delisted the company's shares from the stock exchange in 2019. So what is the position in 2019 and 2020? Because we are saying you have to consider the basis in respect of a company which is never following Ind AS. Suppose if this company never followed Ind AS before, for the first time they have delisted the shares, they are not coming to the general rule of no, it is a one-way traffic, you cannot come back. First time I am going to adopt, but my shares which has been listed in 2014 has been delisted. So in that case, it says from the year in which it is delisted, if you are not a listed company, you need not follow Ind AS. That is one criteria. Similarly, 2019, for the first time, I'm listing my shares, or I'm proposing to list in 2019 for the first time. In that case, whether I have to follow only in 2020, the answer is little different. Listing criteria, if I have going to do in 2019, the same year I have to follow Ind AS. Only if the net worth criteria has been met in 1 year, immediate next year will be the applicable criteria for as per the roadmap. This is the roadmap which I was talking about. See, for example, I split the companies into two categories: general companies and non-banking finance companies. This is what I was all along talking about. They have split that into two phases. One set is starting from 1st April 2016. Another set is starting from 1st April 2017. And where they have said that this listed and proposed listed companies having 500 crore or more net worth is covered in the first phase. Unlisted companies having net worth of 500 crore or more is covered. And the step 2 is all the group companies will also get covered. This was the first phase. In phase 2, from 1st April 2017, all listed companies which are having net worth less than 500 crore, even if it is a negative net worth, based on listing or proposed listing, they have to mandatorily adopt. Unlisted company 250 crore or more but less than 500 crore will get covered. Step 2 is all the group companies will also follow. Subsequently, they have issued the roadmap for non-banking finance companies. There also they have given 2 years. One is starting from 1st April 2018, same logic of 500 crore or more for listed and proposed listed and unlisted companies. Step 2 is all the group companies of NBFC. And for 1st April 2019, all the listed NBFCs and proposed listed NBFCs, irrespective of the net worth. For unlisted NBFCs, 250 crore or more, but less than 500 crore of net worth. And step 2 is all the group companies of that particular entity. Now, what is not covered so far is banks and insurance companies. They are waiting for the notification from Ministry of Corporate Affairs, because they believe that the impact of IFRS implementation in banking sector and insurance sector will be much more than implementing in an NBFC or in respect of a manufacturing or a trading company. That's the reason why they wanted to have a little bit of time. So it is deferred, but no timeline has been yet made mandatory. Just to have a quick look of how the implementation is happening, when they will start and when they do. I'm taking a company which is preparing the financial statement for the year ending 31/3/2021. So for that, normally the company will give 1 year comparative. So Indian Companies Act requires that current year number, previous year number you have to give. So 31/3/2020 means 31/3/2021, if it is going to be the financial reporting period, 1 year comparative is to be given for 31/3/2020. Okay. But for getting that 2020 numbers, I should have an opening balance. What is the opening balance available for me as of 31st March 2020? It is audited as per IGAP number, Indian GAAP number, not as per Ind AS number. So accordingly, the opening balance sheet should be converted into an Ind AS number. That is nothing but opening date of the comparative period is 1/4/2019. This date is called date of transition to Ind AS. This is the date on which we have to prepare opening balance sheet as per Ind AS. There is one session called Ind AS 101, which is going to talk about first time adoption of Indian accounting standard, where they will be specifically talking about the process of preparing the opening balance sheet. I normally say it is like a bank reconciliation statement. So there is a specific session, so I'm not getting into that. So this 1st April 2019 to the comparative period, 31st March 2020 is called the comparative period. And I put 3 periods, nothing but suppose if it is a listed company, they are supposed to make presentation of unaudited quarterly results also. This will be comparative quarters for the reporting period of 31st March 2021, which is called a reporting date. And the interim period, which will be presented by the listed company or proposed listed company as an unaudited result, is 30th June 2020, for which comparative will be 30th June 2019. September 20 will have comparative of September 19. 31st December 20 will have a comparative of 31st December 19. Now, for 31st March 2021, full-fledged financial statements as per IND AS will be presented along with 1 year comparative, and you are supposed to show what was your opening balance sheet in the balance sheet. So 3-period financial statement will be presented. So opening balance sheet plus transactions which has been processed as per IND AS for the comparative period gives the comparative period financial statement. Closing balance of the comparative period is nothing but the opening balance of the current period, and the transaction of the current period is processed, you will get current period financial statement. You will prepare complete notes on accounts for the people to understand the financial statement, and you are also supposed to give reconciliation of certain items. For example, you have already stated some reserves as per existing accounting standards. Now you are changing the reserves because of transition to IFRS. So why that difference has come from the reserves as per IGAP to as per IFRS converged Indian accounting standard? You have to give a reconciliation. Similarly, you have reported a profit for 2020 March in your profit and loss account as per accounting standard AS. Now you are switching over to IND AS. IND AS has a different recognition principle. Because of that, the profit may undergo a change. So what are the changes which has happened on that? You have to give a reconciliation of the profit as per the previously reported accounting standard to what is the profit reported as per the IND AS. Those key reconciliations should also be part of it. And of course, the notes on account should explain how an entity transition from accounting standard to IND AS. If you see the financial statement, it is interesting to see every line item will be cross-referred with a note. So to that extent, you will be able to understand the notes in the accounting principles in a very detailed manner. There are some conceptual differences which is normally has to be bear in mind. For example, substance over form. We are not going by the legal agreement. We are actually going into the form of a particular item. I will give a simple example. Preference shares issued by the company is considered as share capital by our existing accounting standard. Whereas the preference shares, which are redeemable preference shares, is to be settled by the company on the redemption date. When you have taken a loan, you are settling on the due date. Similarly, a redemption of preference shares is also redeemed on a particular date, which is already set. So how it will be different from a liability? So IND AS says it is nothing but, even though your form is share capital, but substance it's only a liability. Show that as part of your financial liability. This is one interesting factor. Second is, historically we are using only a concept called historical cost conversion under AS. Now we call a concept called fair valuation also. That means what is the value of the asset or liability as at the reporting period. State that at the fair value in certain cases specifically required. That is another interesting factor which will make the differences between IGAP and IND AS. Any change in the accounting policy has to be retrospective and applied, and that is another interesting factor. The fourth interesting factor is long-term assets and liabilities. Still, for example, if I have paid a rental deposit today for acquiring a premises on lease for 10 years, the rental deposit is non-interest bearing. It will be refunded after 10 years. But whether the purchase power of the deposit which I have paid, for example, I have paid 1 crore deposit today, whether that 1 crore will have the same purchasing power after 10 years, the answer is definitely no. So we are considering at the historical cost of 1 crore as a rental deposit, whereas it says you have to find out what is the net present value of that particular asset, which are going to be realized at 1 crore after 10 years. What is the present value today? So NPV, net present value, which we are using, say, discounting for time value of money has to be considered. There are some options, there are some mandatory exceptions which are provided by the standard, which can be adopted by the company, but extensive disclosures are required and recognition principles are very strict. So we have to use those principles. And the major criticism for India is that standards are prescribing the accounting treatment. Never ever ask the question about what is the impact on taxation. Taxation is a different ball game. So there is a divergence with the taxation laws that should also be bear in mind. Now, how we are talking about the financial statements. I'm not going into schedule the actual Ind AS 1, which is talking about the uh, financial statement, how it should be presented, presentation of financial statement. But I'm only going to the format. It's not format, it's a format. There is a typo error. Format of the financial statement is prescribed by Schedule 3 to the Companies Act. We will just look into that to some extent. Normal companies means companies not following Ind AS. They will follow Division 1 of Schedule 3. Normal companies which are Ind AS following companies, they will use Division 2 of Schedule 3 to the Companies Act. Non-banking financial companies which are following Ind AS will use Division 3 of Schedule 3. So there are 3 divisions of Schedule 3. The student should be able to understand all the 3 formats. But understanding the format of Division 2 and Division 3 is not very big trouble, because it goes with a concept called current asset and non-current asset, and it is easy for people to understand that concept as well. And as I have mentioned very clearly, consolidated financial statements are mandatory even if the company has one investment in another company. So that should be prepared as per Schedule 3 requirement. What is a component of financial statement? Balance sheet is a component. Statement of profit and losses is a component. Statement of cash flow is a component. But the interesting new component is called statement of changes in equity. You have to present this as a separate statement showing what was the amount which has been contributed by the owners of the entity. Who is the owners? Equity shareholders. So what is the share capital which has been contributed? What are all the other items on which they are entitled for? Reserves and surplus is the other item. So they are classifying that into 2 categories: A, equity capital; B, other equity. You have to show the movement right from the opening date, what has happened in the current period, what is the closing balance. That will be a new component of financial statement. And of course, notes on accounts, elaborate guidance has been provided. I just thought that I will share you how a listed company has actually presented its balance sheet to have an overall understanding. But at the same time, I would like you to tell me whether this Excel file is also visible on your screen. Sir, this Excel file is visible on the screen, sir? Sir, the administrators, can you confirm that it's visible on the screen? I assume that it is visible on the screen.
Sir, it is visible, sir.
It's visible. Thank you, sir. So if you see that, you will see the screen. You will see the screen in which you will see I have given 3 periods balance sheet: 20 March, 19 March, and 2018 March. Okay. So if you see this, what is interesting to see is that this is the year in which I present the financial statement, and this is the comparative period which we are talking about, and this is our 2018 financial statement. Okay. So the way in which it has been presented, one second, sir, I will just. So what we see is basically 3 periods financial statement. One is 20 March, one is 19 March, one is 18 March. 20 March is the period for which we are presenting the financial statement. On the corner. எனக்கு தெரியுற மாதிரி அந்த காணொலி எனக்கு தெரியுற மாதிரி okay. Sorry, I'm just trying to follow whether the screen is also visible for me or not. So if you see the balance sheet presentation, it actually shows that the balance sheet has to be presented on non-current asset and current asset basis. So our normal balance sheet, when we prepare as per the AS, you will normally look at one aspect. That aspect is that you will start with the share capital, reserves and surplus, then the liabilities, then you will have assets. Whereas here, the assets will be first presented, and that too, what are all non-current asset will come as the first item, and then you will have something as non-current asset subsequent to that. So this is something interesting which you will find it for your understanding here. And the second aspect which you can find it here is that I'm actually bringing a concept called financial asset here. What is financial asset? There is no such concept in our existing GAAP. Our existing GAAP only talks about some investments, assets, liabilities, that's all. Here they are talking about specific item as financial asset, which has to be presented as separate line item on the face of the balance sheet. So one thing which we have seen is current year, comparative period, and the date on which we have transitioned to Ind AS for the first time. So the first time when the company is preparing and presenting the financial statement, they will present the financial statement with 3-column balance sheet. Subsequent year, they will have only current year and the previous year. So the third column will not be there. And what we have also seen that is asset comes as first and liability comes next. Within the asset, we said non-current asset will be the first category, and then we will have the current assets coming in. So for example, inventories are considered as current assets. Investments is appearing in non-current asset as well as in current assets. Why? There is a criteria for determining what is current asset, what is non-current asset. That will be taken by means of principles prescribed under Ind AS 1 in the next session. So I'm not touching upon this, but be cautious that assets and the liabilities has to be presented based on current and non-current classifications. Okay. Now, once you have presented the current assets and non-current asset, we normally make a subtotal for each of the items and then main total for this item. Then comes, previously we used to show liabilities, but the side itself is called equity and liabilities for you to understand this. And as I have mentioned that in respect of equity, it will be considered into 2 categories: equity share capital, other equity. The other equity and equity share capital will be form part of the statement of changes in equity. There is a subtotal which has been provided for total amount from the shareholders. And secondly, liabilities is presented into non-current liabilities and current liabilities again, right? So again, subtotals are presented, and that is the way in which you will see how the total liabilities are made and how the total of the balance sheet comes as a grand total, right? This is a simple method of understanding the format. What is the format? asset, non-current asset. Within that, financial assets also separately to be shown. Then liability side, equity and liability. First equity, equity share capital, other equity. Then you have non-current liability and current liability. It's simpler than what we had previously as part of our existing Schedule 6 format, which has been given as per the Companies Act 1956 at that point of time. But IFRS uses different nomenclature. For example, we say that this is balance sheet. IFRS says this is statement of financial position. What is my position of assets and liabilities at a point in time? So they use the word statement of financial position. We call that a statement of profit and loss. IFRS says that it's a statement of financial performance. What is my performance during the year? Statement of cash flows, there is no change. Statement of changes in equity, no change. But this balance sheet and P&L, they are using a different nomenclature. And you are expected to present all components with equal prominence. So this is what you have seen in the balance sheet, how the assets and liabilities are presented. This format is actually coming from Schedule 3 to the Companies Act. There is a standard called IND AS 1. IND AS 1. But IND AS 1 is not prescribing a format. It only explains how the assets and liabilities should be presented. What is the criteria for non-current asset? What is the criteria for current asset? What is the criteria for non-current liability? What is the criteria for current liability? But Schedule 3 gives a specified format because Indian companies has to follow Companies Act 2013. This schedule is mandatory requirement. As you remember, I talked about Division 2 of Schedule 2 for normal Ind AS companies. For a normal Ind AS company, and Division 3 for NBFC. That is the only thing which you have to keep it in your mind. Otherwise, you are done with the balance sheet. Again, IFRS has not prescribed any format. That's what I wanted to say. In the statement of profit and loss account, we have an interesting factor called it's a single statement approach with two sections. What is the two sections? Comprehensive income and other comprehensive income. Again, this will be dealt in depth with Ind AS 1. The expenses and income should be presented based on nature and not based on function. What do you mean by that? Salary or employee cost is a nature of expenditure. Consumption of raw material is the nature of expenditure. Changes in inventory is the nature of expenditure. Finance cost is the nature of expenditure. That's what exactly it is saying, that you have to follow that principle. But you cannot say administrative overheads, salary cost, depreciation on the administrative vehicle, all those things cannot be taken. That's a functional classification. IFRS allows functional classification, but Ind AS allows only nature of expenses model. Again, Schedule 3 gives you the format which has to be adopted by this. If you see how companies have actually presented their profit and loss account, when I am saying two sets of financial statement, you will see very quickly that this is nothing but current year number and previous year number. There is no opening balance sheet like 2018 because we are only converting the balance sheet into Ind AS opening balance sheet. That is the reason why we are giving that. P&L is not being touched for 2018 March. So we just put that number. So your income, expenses, this is what nature of expenses model: employee benefit expenses, finance cost, depreciation, other expenses. And then you will show what is the profit from continuing operation, what is your income tax expenses, what is the profit for loss for the year. Up to this A to D is nothing but, up to A to D is your A to D is your comprehensive income statement. What is your OCI? Starts from here other comprehensive income statement. This OCA or the other comprehensive income statement, if you see this way in which it has been explained, those items are unrealized gains and losses, and they are coming from specific accounting standard. In simple terms, I could say, unless an IND AS specifically requires, unless it specifically requires, no item can be put on OCA. So specifically, it will say that this item should be part of other comprehensive income statement, and whatever is the law or tax relating to that should also be put as part of this. And this item and this item put together is what we are showing as total comprehensive income for the year. And of course, earnings per share comes from a different standard, and Ind AS 33, that standard requires you how to compute your earnings per share, basic earnings per share, diluted earnings per share, etc. That is how the company will present its P&L account. And going to the next thing, what we will say is the statement of changes in equity. Here, if you see, I have told that opening balance of each component of equity, what is the current year transaction, what is the closing balance you have to give. In simple terms, it actually gives a reconciliation. I will just show you how a listed company has actually shown this movement in its financial statement. Opening to closing, there is a reconciliation. How it is happening? As I have said, it's split into two categories. One is equity capital and Sir. Yes, sir. Sir, when we have lost that link, sir? Okay. In which slide we have actually lost the situation, sir? Okay, 2-3 minutes back. Okay, okay, sir. Then nothing is lost. Okay. Sorry for the technology trouble. I normally say that the technology is like my wife, it never listens to me. So I have to cajole it and then make it to understand. So you are able to see the screen now, right? Professor sir, you are able to see the screen?
Yes, sir.
Okay, okay, okay. Seen. The problem which I have seen is basically because I was using some Excel file and coming back to the main screen. So in that case, the software is actually disconnecting me from the main screen. Not a problem because all the Excel files have been already shared. So what I am supposed to show you the balance presentation. And in the presentation, if you see, one of the requirement is that you have to round off the financial statements. It says that you have to either give full numbers or you have to go for a rounding off. If I have not opted for full figures, but I'm using a rounding off, then it says that you have to follow certain rules. You will see me now, right, sir? Including the voice.
Yes, sir. Yes, sir.
I think that the software is having some problem with me. But anyway, the presentation has been already done, sir. We can take a few questions in case if the participants want to ask any questions.
Okay, sir.
Questions తీసుకో. Questions. Madam,
Good afternoon, sir.
Good afternoon, sir.
Good afternoon. Good afternoon. Thank you. Thank you for your nice presentation, sir. This is the second presentation with us. First time on the 3rd September 2020, you had given a nice presentation, and this is the second time. First time also, the viewers, audience felt very happy. I think today also our participants felt very happy with your nice presentation. So before thanking you, I wish to ask a few questions.
Yes, sir.
If you please try to clarify some.
Yes, sir. Yes, sir. Yes, sir.
Sir. So first question from Kumar BR, Assistant Professor, Department of Commerce and Management, Kollegala College. Difference between financial assets and financial instruments. He wants to know,
Okay.
is there between financial assets and financial instruments?
Okay. Sir, it's a simple concept. When we are talking about financial instruments, the standard on financial instrument IND AS 32, IND AS 109 and IND AS 107 says financial instrument includes financial assets and financial liability. It's a common term. It includes both assets as well as liability. That is what financial instrument, the term of financial instrument. Financial asset covers only the assets which are financial in nature. So liability is financial liability. If I'm trying to give a common term for referring both financial liability and financial asset, I use the word financial instrument. That's all, sir. For example, when the company has issued a debenture, we say that it's a financial instrument. But the financial instrument is actually resulting in a liability, financial liability for the company. If I'm an investor, that is a financial instrument which has been issued, but it becomes an asset for me because I'm the investor. So financial instrument is combining both the words assets and liability, common terminology. Asset is a subset of financial instrument.
So second question, Madam Shilpa, JSS College for Women, as IND AS are converged IFRS standards with some carve-outs and carve-ins, will it reduces the global level acceptance of IND AS standards?
Okay. So this is the basic criticism which we are having, because when we said that we wanted to have a common accounting language, and still we are making certain differences between IFRS and IND AS, whether it is a global accounting language or a common accounting language is the criticism which we are normally come across. That is the reason why the Institute of Chartered Accountants of India and Ministry of Corporate Affairs, when they initially implemented IND AS in 2010, originally when they have planned, there was 21 items of carve-in and carve-out they have planned. Now it has been hardly reduced to only 4 items of carve-out. And the 4 items also now reduced to only 2 items. One is basically your discounting rate, which we adopt for discounting rate to determine any net present value using government bond rates, whereas IFRS allows high yield corporate bond rates also to be used. But if you see today, there will not be big difference between these two. So that is one carve out. So it is not having a material impact. Another carve out is capital reserve and gain on bargain purchase. IFRS requires to be recognized as in the P&L account as an income, whereas we take that as a reserve. Only these 2 items are the real items which are still standing out. And to that extent, when we are explaining, it is not defeating the purpose of being a common accounting language. So your reconciliation can help people to understand that very easily.
Sir, another free Lakshmi from Christ
Yes, sir.
College, Mysore, has two questions to clarify.
Yeah.
What would be the reason for framing mandatory rules to adopt IND AS related to any tax evasion? And second one, if the company's net worth is 249.9 crore, should they apply IND AS or not?
Okay. The first question is in respect of tax evasion. The net worth or IND AS, whether they are going to prevent any tax evasion. I could say that the tax laws are different and the principles of preparation and presentation of financial statements are completely different. And accordingly, whether it will avoid tax evasion is a questionable statement. Maybe to some extent, I can say the transparency involved in explaining the accounting principles as disclosures will enable the users to understand the concept easier. So the similar way, the tax authorities can also understand. Little bit of transparency may avoid a tax evasion, but I believe that it's a remote connection because tax laws will suggest how the taxation should be done. That is on the first part. In respect of the second question, 249.99 crore, it is like a rule. So 250 crore and above. So even if you are less by 1 paise, you are not supposed to be under IND AS. So to that extent, we have to agree with the reality of the decimal points also. It is not rounded off to the nearest rupee. It should be still considered as less than 250 crore.
Sir, the fourth one from Vishakanta HL, that the Government First Aid College, Bulhalli. In convergence period of time, how do you adjust the asset value using inflation as different countries is having different inflation?
Okay. When I prepare a financial statement under IFRS or under IND AS, the financial statements are following two principles. One, in respect of certain items of assets and liabilities, historical cost conversion. In respect of certain other items, it is only following the principles of fair value measurement. When I am doing the fair value measurement, the fair value is automatically considering an adjustment for the inflation related adjustments. For example, what is the value of an asset in India and what is the value of that particular asset in another country could be different because of the different inflation rate, different purchase power, etc. Actually, IND AS 113 or IFRS 13 on fair value measurement considers that also as an element to determine the fair value. So to that extent, it is automatically getting adjusted in determining the fair value. So nothing to worry about it, sir.
So next one from MS Diveshri, Belikere First Aid College, regarding IND AS 103, business combinations net assets. If the company pays more than net assets, it is treated as goodwill.
Yes.
And if cost of acquisition is less than net assets, it is considered as capital reserve. You see that it is a carved out issue in IFRS 3. Please throw us light regarding fair value measurement differences.
Okay. Actually, if you're seeing in IFRS 3 as well as IND AS 103, when one entity acquires another entity, what it says is on the date of you taking over the control of the other entity. That means you are subscribing to more than 50% of the share capital, or you are replacing the existing directors by means of your own nominee directors. You have the control over the other entity. The date on which you are taking the control over the entity, you have to find out what is the fair value of the asset, what is the market value of the various assets you are taking over, minus what is the fair value of the various liability you assume that you will settle on a go forward basis. That becomes a net fair value of the assets taken over. So fair value is nothing but the market price subject to certain conditions. When somebody is taking the session on 113, they will explain the exception. Normally the transaction price is considered to be the fair value, normal scenario, except if it is a related party transaction, etc., where you will look into whether you are agreeing for a price less than the market price. Normally market price is fair value. Because the market price has been taken as the fair value for the assets and liabilities, the net fair value of the assets taken over minus your consideration is considered either as capital reserve or goodwill, as the case may be. Determination of fair value goes along with Ind AS 113 to determine for the assets and liabilities on the date on which the company takes the control over the other entity. Yes, sir.
Sir, one general question from our side.
Yes, sir.
Adoption of IFRS impact on the financial activities of companies in India.
Okay. Sir, actually, a lot of study has been done. I could suggest the users of this particular conference to go to the Institute website, Institute of Chartered Accountants of India website, under which there is a tab called Committees. You go to Non-Standing Committee, Accounting Standard Board. In Accounting Standard Board, there is one publication which they have assessed. What is the impact of using this Ind AS standards on the financial statement? They have given one publication, very interesting publication. But what has happened was, every company adopting Ind AS for the first time, they actually made the impact to be compensating with each other. For like what I have given an example of, on the debit side, I have 53,235 crore. On the asset side, on the credit side also, I took around 50,000 crore. So on a holistic basis, the impact is not very great. That's what I have seen. Over a period of time, it is not having a very dramatic impact on anything. Yes, maybe for certain industries, for example, non-banking finance companies, a concept called expected credit loss. That means you make a provision for your doubtful debts on the basis of what you think in the economy will change and what is the additional provision required. That could be industry-specific issues, but I have seen in my experience of 78 companies being transitioned, majority of the companies are not having a very big difference or very big impact when they're changed. But the real benefit which has come is the transparency in reporting, make the investors to have a more informed view on making investment in the company, giving the balance sheet more transparent and comparable strength for the investors. This is the two benefits which I have seen actually. And on the impact, I have not seen much impact on transitions.
Sir, one last question from participant.
Yes.
Will the conversion affect multinational companies' operations in India?
Sir, conversion per se will not affect only multinational companies in India, but I should say that it will affect all the companies who are transitioning to Ind AS. But one thing which I have seen is that with IFRS being adopted in India, multinational companies are ready to invest in Indian companies. So the inbound investments are coming higher. So if you are thinking that that's one of the impact, that's a positive impact. It is actually positive impact. The multinational companies who are setting up that subsidiary in India are also more comfortable because the way in which subsidiary prepares also equivalent to what they prepare in the parent company level. So that is actually a positive impact on the multinational companies when adoption of Ind AS has been happened in India, sir.
Thank you, sir.
Thank you so much, sir, for an excellent opportunity and more interactive questions coming in.
Thank you. We sincerely thank you for accepting our invitation and for the virtual inaugural session and for giving a bright start for the 3-day faculty development program organized in our institution. I think I have already told you this is the second interaction with us. Once again, on behalf of the Vidyavardhaka Sangha management, Sri K. Puttaswamy First Aid College and our principal and from all the participants, I once again wholeheartedly thank you for your nice presentation.
Thank you, sir. Thank you, sir.
And I thank all the participants and I request all the participants to have your lunch and be prepared for the afternoon session. I thank you once again. I thank all the faculty members, technical personalities, and once again I thank you, Chinnaswamy Ganeshan sir. Thank you, sir.